I want to introduce Haynie and Company will be our panel today. The topic is better accounting for a better sale of your business. We've got over half a century, not to date anybody, of experience here on the stage. So we're going to focus on the tax, audit, and the quality of earnings. And Chris, I will hand off to you.
Awesome. Thank you, Tom. I really appreciate it. So today, everybody is so excited about accounting. Isn't that what everybody loved? Woo! Well, up here on stage, you've got three passionate accountants. I'll call myself dispassionate, but we have audit, we have tax, and we have transaction advisory. I do CFO fractional services, outsourced accounting, a lot of preparation and sell-side due diligence. But you've got the experts up here. And the focus today is, how better accounting through tax, through audit, through quality of earnings, how better accounting can help you raise the value in a transaction or help you through a transaction. So I'm going to have each of them introduce themselves briefly, and then I'll introduce myself a little bit more. So Scott, why don't you lead off?
Yeah, I'm Scott Jensen. I'm a tax partner here at Haynie and Company. Been in the industry since '08 and have a CPA and CFP as well, but just focus all in on tax and tax strategy.
My name is Rob Abercrombie, and I'm an audit partner with Haynie. I've been doing this for 20 years. And when you work in Utah, you've seen a lot of different industries, a lot of different transactions for your clients and others that are doing transactions. So, but I'm happy to be here today and talk about audit, which I love. So.
And I'm Steve Avis. I'm an audit partner at Haynie and Company. I've been in public accounting for 27 years, I think. I'm not very good with numbers, so it's kind of a roundabout place there. But 27 years in public accounting, the last 10 years at Haynie and Company, and I'm also the head of our transaction advisory services group at Haynie.
Awesome. Thank you, guys. My name's Chris Badger. I'm a CPA. I do fractional CFO services and outsourced accounting. So more than 20 years ago, I left Arthur Andersen and said I'd never go back into public accounting. And guess where I'm at? So be careful what you say. It may come back to bite you. But we are excited here, and we're going to start out a little bit with taxes, talking about that one triple B, or is it I triple B or O triple B? The one big beautiful bill.
B cubed.
B cubed. B cubed is the name today. Talk to us a little bit, how, as a business owner, what's really changed with the tax situation with the one big beautiful bill?
Yeah, as a owner, some things to be thinking about. So there's some change to the quality or the QSBS quality. Oh man, now qualified small business stock. Yeah, geez, how did I miss that? And also known as 1202. But also there's been some changes to asset sales as far as with bonus depreciation and how that's been playing into the market for people that are looking to sell their business and what that means for them. But then there's also been changes to the estate tax and the increase to the exemption to 13.9 million this year. And that was slated to go down to 5 million, as many of you know. But that's pegged to continue to increase and was made permanent with the tax code. So.
With the one big beautiful bill.
Yep. Yeah.
One big load, depending on how you look at it. So one of the big questions that I've been asked is every seller wants to sell the stock in their company, and every buyer just wants to buy assets. And so with the one big beautiful bill, what does that change in that scenario with either a stock purchase versus an asset purchase?
Yeah, with the stock purchase, so putting aside the QSBS, just because that has its own rules, and we can cover that here in a little bit. But yeah, if you're an owner and you're looking to sell, right, stock or versus assets, the stock is what as an owner, you're going to look to be trying to do, where as a buyer, you'll want to try to come in and do the asset purchase, because that will give you the extra opportunity for more deductions right up front, especially with that 100% bonus depreciation, and really help with the cash flow and just walking in the door. But it really depends on what way is best, right? It depends on what your goals are as a business owner. It depends on the market. It depends on the industry you're in, the company. We had one that closed just a few months ago where they had a few main clients, and those were multinational clients. And in order for them to secure new agreements with these companies, it would destroy the company. So they had to do a stock sale so that the EIN wouldn't change and they could continue to service these clients without any disruption. So short answer is it really does depend.
Yes, I love that. That's the CPA's answer for everything. It depends. And it certainly does when we're talking with sales and transactions. We'll come back to that qualified small business stock here in a few minutes. But let's talk a little bit about audits and reviews. And so a lot of time companies are trying to figure out, you know, do I want to pay for an audit? Do I want to pay for a review just on a regular basis each year? And so, Rob, tell us a little bit kind of the difference between what goes into a review, what goes into an audit, and then talk a little bit about ballpark pricing so that our audience members can understand that.
Sure. So I'm not sure how many of you have been through an audit. Anyone been through an audit with your company or someone you're affiliated with? I know many of you may have, but you know, as you go through an audit, a lot of times people are surprised how involved it is and actually how costly it can be. But there's always a good chance if you go through a transaction that you may need an audit, or you know, you may need financing that needs an audit or a review. So I'll talk about those two types of assurance services that a CPA firm will provide. And there are others certainly, but I won't talk about those. Reviews and audits are certainly the most popular. And so a review is a lower form of assurance. And so a review is just that. It's primarily analytics and inquiries. You'll often look at some documents. You'll speak with the owners. And based on those inquiries and analytics, we're giving limited assurance that some companies' books are, you know, accurate. So, but it's less in scope than an audit. So, and on the audit side, an audit will be more in depth, where we're actually looking at transactions. We're looking at the details behind transactions, and those all feed into your financial statements. And so we never give, an auditor or a CPA firm will never give absolute assurance, but we'll sample and look at a lot of your transactions to make sure everything is reasonable. And so, you know, when you look at the cost of doing these types of assurance services, clearly a review is going to be a lot less. And it's sort of a loaded question, right, Chris? It sort of depends. There's the CPA answer, but you know, a review can go from, you know, start in price from, you know, $5,000-$6,000 up to 20, right? And then if you're doing an audit, it's usually up from there. So like, it depends on the size of your company. It depends on how complicated your business is. It depends on how messy your books are. All those types of things go into the cost. And so our typical audit range will be anywhere from, you know, maybe $15,000 to a couple $100,000, you know, and most of our audits are somewhere in between. So I think people are often surprised how much an audit can cost, and so I think it's very helpful to just sort of understand what you're getting into as you go down some sort of transaction path, that it may cost some money. So
Yes.
is that fair?
It's one of those things where talking with companies that are going to prepare to sell, having an audit is kind of like the gold standard, because the first thing that the buyers are going to ask for when they come in and they meet with that company, the first thing they're going to ask for is, do you have audited financials? And if you have audited financials for 2 or 3 years with a good firm behind it, like Haynie, that's the gold standard. That's going to look very good on the seller's side, and it's going to add value as you go through that negotiation process. Having those financials audited and having it's not a guarantee, but you're going to have a report, an audit report from a good firm, is going to add a lot of value in that transaction. Now, going from the gold standard, Steve, let's talk a little bit about quality of earnings reports. And so for a lot of companies going through sale, maybe they've never been audited before, or they've never had financials looked at before. But Steve, talk to us a little bit about quality of earnings and tell us, how do they differ from what Rob just talked about with a review and an audit? Where is that quality of earnings? Where does that come in to play, and what really is it?
Okay. A lot of people will ask, well, I've got audited statements, why would I need a quality of earnings? Well, an audit and a quality of earnings are complementary to each other. As Rob mentioned, an audit looks at the numbers, validates them, are they correct? Are they everything in accordance with GAAP? And are things materially correct? So that's a real backwards looking view on your financial statements. A quality of earnings is kind of a forward looking view. It will then take those audited financial statements and we adjust EBITDA for non-recurring items. So it's going to adjust out, say you've got, a few years back everybody had a PPP money, that was free money that come to the company. They would record that as revenue. Well, from a quality of earnings perspective, the goal is to try to paint a picture of what a potential buyer could expect on a go-forward basis. Well, they can't expect to get PPP money every year. So a quality of earnings, one of the steps will be to factor out those non-recurring items, both revenue and expense. You can get some expense side things that are non-recurring. For example, you could have owner's compensation that would be, if it's a sole proprietor or a limited number of owners and they're in management, their compensation could be in excess of what you could pay a normal person to run the business. So those things would be factored out. That expense would be factored out of your EBITDA. We would also look at the quality of the earnings. So are all of your revenues on a recurring contract basis? Or do you have to go out and find a brand new customer every single time? One of the things we would look at is customer concentrations. Are 50, 60, 70% of all your revenues from a single customer? Well, if that customer goes away, what do you expect? So the quality of earnings looks at these types of things to say, what can we expect on a go-forward basis? So in short, an audit validates what you've got, and a quality of earnings evaluates what it is. How good is it, and what can we expect going forward?
Awesome. Thank you, Steve. With the quality of earnings, as you go through, since a lot of times with investment banks and business brokers, a lot of them are requiring a quality of earnings to take them out to sell. Tell us a little bit about what are some of the red flags, or what are some of the things that you see, or what are some of the things as you go through that quality of earnings process that are going to impact the transaction, or it's going to impact the value of that company. Tell us what are some of the red flags, or if you have a horror story, you could tell us too.
Oh, there's always horror stories. One of the biggest things to look out for is revenue recognition policies. A lot of times if a business hasn't been through an audit, a lot of times they will be on a cash basis. And as you know, sometimes businesses will get cash, they'll bill up front, and they get cash up front for the service, and it hasn't been provided yet. And so there's a deferred revenue involved there. But most, if they're on the cash basis, they won't record it that way. They'll simply record the cash as revenue. So that's a big issue to look out for. Are there deferred revenue items that are there? Another thing to look out for are inflated EBITDA adjustments. As I mentioned, if you're doing a sell side quality of earnings, so the owner of the business, he's paying for the transaction, he's going to want to get the EBITDA as high as he can get it. So the tendency would be any add back you can find from an expense, let's add that back in there. Well, you might get too aggressive in those add backs, and some of the things are trying to say, well, that won't happen going forward, really will. So that's something to look out for. I mentioned concentrations in customers or suppliers. That's a big red flag to look at if you've got all of your eggs in one basket, both from a customer standpoint or a supplier standpoint. That adds risk to the transaction. There's opportunities to manipulate working capital. So part of what a quality of earnings will do is it will help determine what the working capital peg needs to be at the close of the transaction. How much money needs to be left in the company for it to operate on a 3, a 6, a 9, maybe a 12-month basis. That gets negotiated at the sale, but what are the true working capital needs of the company? Well, businesses oftentimes will try to manipulate that to make that working capital look as low as needed. They will play around with their payables. They'll defer capital expenditures. They'll delay repairs and maintenance costs so that they don't hit the P&L, so it doesn't show up as an expense item. And then I think probably most important is the quality of the records. Do they have good internal controls? Do they have agreements for their sales contracts or purchase contracts? Do you have all of those documents lined up, and do you know what the story is? So those are some things that can really hinder a sale and a transaction. A horror story related to that, just this last fall, one of our tax partners came to us and said, I've got a client with a signed letter of intent, and they're undergoing a quality of earnings, a buy side, so the buyer was going through this process, and they're asking questions that he doesn't know anything about. Can you help out? So we jumped in, we started looking at it and said, well, yeah, we've got the exact same questions. What the heck is going on here? And by the time the whole thing was said and done, the accounting was done incorrectly. The accountant lost his job, he was fired, and the deal fell through. It just didn't even happen because they didn't have some of these things in place. They didn't have good books and records. Their accounting wasn't done correct, and it caused the transaction to fail.
Yeah, I've seen it. If companies can't go through a quality of earnings, they're not going to get through a due diligence process. So I always look at a quality of earnings as like a dry run for your due diligence. And so if you can't make it through a quality of earnings, it's not going to be a successful transaction.
Well, and what we're finding is it's key if you're selling a business, I think it's key to get in early and to get that quality of earnings done beforehand, because what we can do is now we're on the sell side, so we're an advocate of the company and what you're trying to sell and accomplish. We can help you craft your narrative and tell your story. We can say, okay, here's something that happened. Why did it happen? And can you say, okay, well, that needs to be excluded from EBITDA, and here's why. The owner knows what the issues are beforehand. They've been identified. They can craft that story and drive the narrative. And when you have that in place, it instills a lot of confidence from the buyer's side.
Awesome. Thank you, Steve. Let's get back to that 1 triple B. Okay. Talk to us a little bit more with changes in the qualified small business stock and holding periods and percentages and things, because it used to be like, golly, you've got 5 years or nothing, but things have changed. Hopefully it's better for business owners, but talk us through some of those changes that came through in the bill.
Yeah, with the QSBS. So there has been some changes on there. And so the way that used to be is that you could exclude 10 times the owner's basis or 10 million, whatever was greater. And the way that changed is they expanded it from just 10 million to now 15 million. So you can exclude from your gain 15 million or 10 times the owner's basis. Also, so as far as holding periods go, they tiered it. So now if you hold the stock that qualifies for 1202, and you hold it for 3 years but not 4, that 3 years qualifies you for 50% gain exclusion, where if you hold it for 4 years but not 5, that qualifies for a 75% gain exclusion, where then once you pass that 5-year hurdle, then you have the 100% gain excluded. But the one thing to note there, on that 50% and on the 75%, so on years 3 and 4, on the gain that is includable, that is taxed actually at 28%. So it's at a different capital gains rate than most of us would see normally. So it's kind of unique that way, where it gets hit with 28% instead of 20 or 15%, depending what capital gain bracket the owner falls into. And then as well, so the way that it was written was that 50 million was the upper cap for how many assets you could have. These would be gross assets without netting any liabilities against them. And that's been included or expanded to be 75 million. So it really has expanded to make it more inclusive for private equity coming in, right? Make it more attracted to investors coming in and getting those founder shares, or people starting C Corps and being able to qualify themselves for that gain exclusion.
Yeah, I always like it when people set up a new company. They always go, well, I want to be an LLC and I'll do partnership or I'll do S Corp, right? Now there's a reason why you would pick to be a C Corp. And that's a pretty nice exclusion from taxable income if you sell successfully. And so you have to be planning, you have to be very proactive. It's not something you can set up this month and be able to close in December, but it's a long-term plan that can save your clients a lot of taxes in the future when they sell.
Yeah, more than anything. It just gives the business owners more options, right? A few years ago, I had a business owner. I met him in Vegas. He said he was one of my favorite business guys, and he's like, Scott, I want to sell this business. I'm like, oh, awesome. Okay, we can structure this to get you qualified for the qualified small business exclusion. Like, this is going to be awesome. And he's like, no way. I do not have 5 years left in me. Like, I'm over this. I want to sell this business right away. But now the way that this tiered system works, it could give you some additional options and things to look at as you're tax planning with your clients. Yes.
Just to that point, I'd love some insights. If someone's looking to go from an LLC or an S Corp now, and they're shifting over to a C Corp, what other implications are there, like from the operation of the business? What are the other cascading challenges or opportunities that emerge as you're doing that? We're focusing on this nice tax benefit down the road, but what other factors should be considered?
Yeah, and that's something that's probably pretty unique to the client, where we would want to look at exactly what they have going on so that we could give a full assessment exactly what should be considered and looked at, because there are a number of things, right, that should be played into, such as hot assets or the inventory and receivables. So yeah, that's one that I would want to sit down and look at in more detail with the client. But
I was going to say there's lots of things that are going to impact that election or unelection. So when you drop that S Corp, you can't just pick it up again next year, right? If you're an S Corp right now and you unelect, or what's the proper word, diselect, I think you have a 5-year waiting period. And so that could impact, right? And so it's a process. You have to go through what kind of assets are in the business. Do you have hot assets with, so like think inventory, receivables, and things like that. And so you have to go through and look at it, taxation on a corporate, C corporation side versus individual, and what's your projections going to be for the next 5 years as you're a C Corp. And so those could be some pretty complicated projections, but it could save you quite a bit of money depending on what your operations are going to be like.
Are there, just a follow-up question, are there any specific, for an S Corp or an LLC going to a C Corp this year, in the process of that, are you creating any taxable events that didn't occur before, or you're having to realize appreciation of assets? I mean, is there a taxable event in changing that election, or is it just really on a go-forward basis changing how the IRS is looking at the company?
Yeah, it could depend too on the assets that are there, right? So to give you a straight answer, I would want to look at that entity specifically to be able to assess what the tax.
So it
consequences.
depends.
Yeah.
Yeah, you're going to have to take a look at what's on the balance sheet quickly. So think of a small, clean company with no assets in the balance sheet. It can be a pretty simple disselection and move forward prospectively. But if you have assets, hard assets, capital assets, you got manufacturing, you got inventory, receivables, it can get a little bit complicated in that year where you disselect the S corporation. And so, yeah, it does depend on the company. Please.
So if you have a crystal ball and you know what the future entails, and you start a business as an LLC, you grow it up to about 50 to 70 million, you convert to a C corp at that point, and then you sell 5 years later. I mean, that really maximizes the gain exclusion, right? Because you can get 500 to 700 million of gain exclusion. Is there anything besides having that ability and the risks associated with time and actually getting the company to that point that would prevent a company from going forward with that strategy?
Yeah.
Yeah.
Summarize that question again for us a little bit.
Yeah, tell
Yeah,
me
so-
if I,
Go ahead.
yeah, I could summarize it and you tell me if I
Yeah.
got it right. Yeah, so just if you operated as an LLC and then down the road when you decide to do 1202, switch over to a C corp, and then after 5 years sell, is there anything that you need to consider when you're switching from an LLC to the C corp?
Yeah, because basically you go from getting $15 million of gain exclusion to potentially getting like 500 to 10 times your basis. So if your basis at exclusion is kind of the gross assets or the gross enterprise value, is there any other kind of consideration that would prevent somebody from going down that strategy, besides obviously the fact that you don't know what's going to happen in the future? Can you actually grow into that value and so forth?
Yeah, so then just repeat that, make sure I understand. Is there anything that would prevent someone from doing that other than?
Yeah, like from a tax perspective.
From a
like,
tax
are there any hoops you need to jump through, or is that?
Yeah, so what I would do too is part of your trusted advisors or the people that are helping run through that scenario with them, right? Have them look at exactly what would the tax consequence be, right? Like for that situation. And then, if it makes sense, right, at that point where the conversion would give you, that basis that you're looking for, right? So then when you execute 5 years down the road, that gain is not subject to tax, but along the way, you aren't getting results that were unintended, right? Like, for instance, like you're now a C corp, right? And now you're subject to possibly double taxation. Like you got that 20% corporate tax rate, and then you distribute all the dividends to the shareholders, and then those are going to be picked up and taxed again at everyone's individual rates. And so I would recommend running through the scenario on paper first, right? And then just making sure, okay, at the end of the day, we could save X amount. Is that going to be greater than the cost during this 5-year period?
And think about it, the cost is going to be your difference between C corp taxation versus S corp being taxed at a personal level, right? And are you going to have the same ownership percentage as you have as an S corp going into your C corp, right? And so there's a couple of things, as Scott said, you do a projection of it for the 5 years, and what it's going to cost you to be a C Corp for those 5 years. Is it going to still be more than the cost savings of excluding 15 million in gain? And so it's, in some ways, it can be a very easy calculation, but it can be very complex too, depending on the type of company it is. So, good question. Thank you. If you have a question, just raise your hand, and Josh, our microphone boy, will get you the microphone very quickly. Okay? All right, Rob, you're back up.
All right.
Tell us a little bit about preparation for a company's first audit or review.
Yeah, absolutely. So I'll build a little bit on what Steve mentioned here, right? And really, you know, that's where an audit can be complementary to a quality of earnings or a transaction. But we often have companies or individuals come to us who need that first audit or review. And, you know, one of the common pitfalls that Steve alluded to is really most companies do not have their books in order on a GAAP basis. You know, they're often kept on a cash basis. And so if you're thinking about an audit, it can be a process of, you know, a year or two. Often business owners, they're in growth mode. They're really thinking about building their business, and accounting can be an afterthought. And so at some point, a business owner needs to kind of stop and say, I need good accounting. I need to think about those audits, because if you just start an audit right out of the gate and you haven't thought about those things, it can be very, very costly, and worst case scenario, impossible to do, right? If you just can't do an audit. And Chris, as an outsourced CFO, has seen all of those scenarios.
I've seen
right?
companies that cannot do an audit.
Yep. And so I think the main thing is just think about it. If that's on the horizon and you don't have the expertise in-house, consider someone like Chris's group, consider hiring someone inside, and assess your accounting and your audit readiness, because often you're just not going to be ready, you know, in a week or months even. It's a process over I would say years sometimes. So it's really just a thought. So
Yeah, it's going to take some planning. It's going to take a lot of work, a lot of resources. But again, having that audit in place for a company, that's the foundation. That's the gold standard for buyers when they come in. Again, the first thing they're going to ask for is going to, hey, do you guys have audited financials? Because then they know that the financials are hopefully right. Let's go back to Q of E, and let's talk a little bit how that Q of E process, as you're going through that on a sell side quality of earnings, how that can help you put together the deal and how you structure the deal, and maybe how you might see some good things or bad things as you go through that process that might help you with structuring the deal. If you could talk a little bit about that, Steve.
Yeah, so the quality of earnings process doesn't just help, it actually is part of the whole structure of the deal. You know, as I mentioned, part of this process is to come down to an adjusted EBITDA for those non-recurring items. Well, it's not uncommon for a single dollar change in the EBITDA adjustment can have upwards of hundreds of thousands of dollars of impact on the enterprise value of the business. When you look at that on a go-forward basis, you know, they project it out over a number of years. So even minute changes in your EBITDA number can drive that enterprise value up or down by hundreds of thousands of dollars, which ultimately then is the price that the business sells for. It can affect the structure of the deal. So if you get in your quality of earnings and you find out that they don't have they haven't recorded their deferred revenue, or we see added risks or things that get involved there, it may structure the deal to have buyouts at the end. The buyer might not want to pay all of that money up front. He's going to want to put some buyouts or some earnouts in place so that if those projections don't pan out, he or she's not going to be hurt after, once the deal closes. We've found that the quality of earnings has a direct impact on that working capital peg. How much money has to be left in the company at the time of sale in order for the business to continue for 3, 6, 9, 12 months, whatever that number gets negotiated to. So the quality of earnings has a direct impact on that. And we've found that sellers who have a clean, defensible quality of earnings, it actually increases the sales price and increases or decreases the time of the sale. So it can happen much quicker if they've already gone through and done that process. So it can affect the price, it can affect the structure, and it can affect the speed of which the sale closes.
Awesome. Thank you, Steve. Let's talk a little bit more about that one big beautiful bill with how some of the new deductions or the new parts of that one B cubed, how does that set up, or how can that help in a transaction or help structure a transaction?
Yeah, it could influence the structure a couple different ways, I guess. So one way that we mentioned before was that bonus depreciation, right? So that's going to give added incentive to the buyer wanting an asset sale. Another thing is the R&D tax credit was updated with the OBBB. So the way that the Tax Cut Jobs Act changed this R&D tax credit is that it made all the expenditures related to research and development, they had to be capitalized on the balance sheet and then recognized via amortization over 5 years, which became extremely painful for a lot of businesses. And R&D, often when people hear that, they think about people walking around in white trench coats and doing scientific stuff, but that's not really all that credit encapsulates. But it includes construction, it includes so many different businesses of different industries, as long as there's a scientific process on how to do something better than you've ever done it before. It can qualify for this R&D tax credit. And this credit is a dollar for dollar reduction of the tax liability, so it becomes quite powerful. But what's happened is under the Tax Cut Jobs Act, all these expenditures that were spent to get this credit and just expenditures in total related to research and development as the code was written have to be capitalized. So now they're sitting on the balance sheet, and what's happening is with the OBBB, it says that all those expenses sitting on the balance sheet can now be amortized off in like a lump sum. And the way that that was written is interpreted a little differently between different CPA firms and practitioners. Some believe that that could have happened in 24, and others believe that it has to happen in 25. So as you're reviewing financials or tax returns for your clients, you may see a big M1 adjustment for amortization on there related to they call them QREs, or qualified research expenditures, flowing through that would reduce income. Well, that's related to R&D. So that we've started to see that coming through on 24. Some people are set on doing it at 25, and you'll continue to see that. But two, that provides an incentive for people to buy these businesses and get into it so that they can take this nice credit to help offset liabilities. So that's one, the QBI, that's a qualified business income deduction. That's where the top 20% of income from a pass-through, like a LLC or an S-Corp, is not subject to tax. So that came around in the Tax Cut Jobs Act, and that was made permanent under the OBBB. And then one other thing too, on real estate heavy businesses, where you're looking to exit that real estate or that holding, too, we're seeing cost segregation studies become more important. because of that bonus depreciation, anything that has a useful life as set by the IRS of 15 years or less, 100% of that asset can be recognized in the year that it was purchased, instead of having to recognize it, say, 1/15 over 15 years. So that accelerated a lot of depreciation. Well, on the real estate heavy, say like this building, right? If you're going to sell that, you do a cost seg so that you could allocate a lot of the purchase price or the sales price to things that haven't been fully depreciated, like the building envelope itself, right? And that way, on the sell of that, say like this structure, you wouldn't have to be forced on recapturing a lot of the depreciation and being forced to recognize ordinary income, but rather you'd be able to enjoy more capital gains rates on the sale of those assets. So,
Awesome. Thank you, Scott.
yeah.
And thank you for not mentioning any code or regs during any of
Yeah,
your
section
responses.
171.
Okay.
You got it.
No IRC.
Yeah.
So one last question, and then we'll open up from questions in the group. Steve, talk to us a little bit about quality of earnings and maybe some of the trends you've been seeing over this last year, or how you think things are going to end up towards the end of this year. What kind of trends and what kind of changes have you seen for quality of earnings?
Yeah, there's a lot of money out there in PE firms. They got a lot of dry powder, and they're wanting to get that deployed. We're finding that with those PE firms, they're trying to do due diligence much faster. So they're going to want to get in, get it done as quickly as they can. For family-owned businesses, more sell-side quality of earnings are being commissioned. I've talked to several investment banking firms over the last little while, and several of them have said, we won't sell a business without the sell-side quality of earnings being done beforehand. They're just requiring it. It's a competitive market out there, and buyers just can't afford to find mistakes and problems after the fact. So it's imperative that this quality of earnings get done beforehand and identifies those things. We've seen a lot of slowing for small and middle market businesses because of the uncertainty revolving around tariffs and that. But we're starting to see, people are starting to settle in and say, okay, well, this is going to be the norm, so we can now start to move forward. So we're starting to see an uptick in inquiries for quality of earnings, and deals are starting to move forward a little bit there.
Awesome. Thank you.
Will you set the level set with like cost expectations around quality of earnings? And outside of a transaction, do you see companies engaging them from a strategy perspective, trying to shore up how things are performing?
A cost standpoint there, one of the things I've often said is, how much is an audit? Well, okay, or how much is a quality of earnings? Well, okay, well, how long is a rope? Well, a lot of times it depends. And again, if you go through and you have an audit done beforehand, there are certain quality of earnings procedures that we don't need to spend a lot of time on, where if you don't have that done, there are some added steps that we would recommend. What you'll find is a lot of the larger national firms can have quality of earnings that go $80,000, $90,000, $100,000. However, we've targeted our market to the small and mid-cap market, so we've been able to take that expertise level of producing that high quality of earnings and scale it down to companies that we're targeting, the small and mid-market companies. So we can actually get a quality of earnings in the $20,000 to $30,000 range with the same type of expertise and level of analysis that you would expect out of a much larger one, because we've been able to scale that down. So that's a pricing standpoint. What was the other part of your question?
Looking towards 2026, a Q of E or an audit, like what's the right way to think about financial strategy for a business? Are either of these tools ones you leverage, or is it just basic financial engineering and doing the job of the CFO before you get to an audit, before you get to a Q of E?
Yeah, so ultimately, the pecking order you would want is to have the audit done first. like I said, they're complementary. So if you go and you do take care of the audit, if Rob comes in and does the audit, a lot of those steps and procedures are done. And then we can build upon that to start doing the analysis that the quality of earnings provides. We have done them in reverse order, though. In fact, I've had a project this year where we did that. They wanted the quality of earnings first, and I talked to them and said, we really should, not get the cart before the horse here. No, we need the quality of earnings because we need to get started on this process. So we did that. We went through that process and then stepped over and did the audit and then found some audit adjustments because we were doing detailed transaction testing for the audit that we don't do for quality of earnings. And said, well, now there's some adjustments. Well, now they wanted to go back and readjust the quality of earnings, and I just said, no, let's put the brakes on right there. You're just going to have to tell your potential buyer the order that you wanted this done in, and these differences are a result of audit differences, and they can see what they are. So we didn't want to go back and redo all of that, because some of those adjustments, you'd have to almost start over. So.
Awesome. Thank you, Steve. Let's have a big round of applause for our panel up here today. We'll open it up for questions. So anything you ever wanted to know about accounting, tax, audit, transaction advisory, financial reporting. I know everybody dreams about that at night, but what kind of questions do you have out there, especially preparing for a transaction and doing better accounting?
Chris, I'll just second what was said. The value of quality of earnings. I'm an M&A broker, M&A advisor. We sell businesses. We've got to the point where, like, as soon as we take on a new listing, like, we're gonna go get it because it saves so much time and so much money later on, asking questions, going back and forth, extending due diligence. That just to get it up front with a listing or when you're ready to sell, it's just like, hey, it's expensive, but we're gonna go make it happen. It saves time on the back end. So completely second that idea.
It allows you to be in control of the narrative. You know what the issues are. You've crafted a response to it so that when the buyer asks, you've got a response and you've got an answer and you've got the documents that you can provide. That builds confidence. And when you build confidence, when they have confidence in you as the seller, the deal happens much quicker. And I'm a firm believer that nobody should start a business, buy a business, or get into business without having an exit strategy in mind. So with that, I want to sell the business. Okay, we've got 5 years. No, I want to get out next week. That's way too late to be doing any of that. You need to get out in front of it. We need to talk to our clients and say, hey, what's your plans for the next 3 to 5 years? Well, I'm thinking about selling, getting out. I want to go on a trip around the world. I want to travel. Well, okay, let's start some of these things in place early so that we can help you meet that target date and get the best price available that you can get out of your business.
And the immediate answer, like, oh, I'm just going to hand it to my kids, can't be the first answer or the only answer. It might be the end answer, but it can't be the first or last.
Yeah.
Awesome. Well, we'll open it up. Any other questions we have from the audience? All right, cool. Well, you got these experts are here. If you have some questions one-on-one, please feel free to come up and meet Scott, meet Rob, meet Steve. They can talk anything you want about accounting. And again, we appreciate the opportunity to be here with you guys this afternoon.